Hello and welcome back to my channel. I am Christy Vann with Fantastic Finances, and on this channel I teach velocity banking. Today we're going to be talking with a wonderful expert in the infinite banking concept. I am so excited when he comes on here to talk about what the infinite banking concept means, not just to, we're not talking about the millionaires of the world. We're talking about that your basic American citizen who's averaging that $5,200 a week or a month in paycheck, what you can do with the money that you bring home every month. And Chris is so good about explaining this. He has a wonderful team. Chris, I think that besides introducing you, I want to brag on you a minute because I've been hearing so many great testimonies about what your implementation team does. I really don't think that I had understood exactly what your group does in general until this year, for sure. Not just to get people set up, but to actually show them what to do. So all of that being said, welcome. I'm so glad that you're here today.
Hey, thanks so much, Christy. Real honored to be on here again. And, I just love teaching people how to take back control of their money and how to be their own bankers. And I got a really unique way of showing it. And this is going to be like the first time I've ever showed an audience. So this is kind of a test run, but I think it's going to land for everybody because a lot of people overcomplicate the infinite banking concepts. They make it really complex, or some people make it all about a product, especially designed and engineered whole life, but it is not. The infinite banking concepts, in its theory, pioneered by the late R. Nelson Nash, is a process, folks. It is a process of you taking back the banking functions in your life. Now, what I want to show you today is just imagine this. Imagine every payment that you make on all the debts you make every single month. Just get that around, get your head around that. Your car payments, okay? Just write down your car payment, write down your credit card payments, write down all the debts that you pay out every single month. Now, this is gonna be really at home because this is what Christy teaches. Imagine if all those checks you pay other people's banks for your debts were checks that you deposited into your bank account. Just think about that for a second. Like, what would your life look like? How different would it be? And what if you could do that without working harder, longer, or taking on any additional risk? That's exactly what I want to show you. And I want to walk you through this infinite banking concepts, but I want to show you just the process. We're going to completely eliminate the product until the very end, because if you don't understand the process, you will never, ever be successful with the infinite banking concepts. Christy, is that different than what you've always heard about the infinite banking concepts?
Just to be honest with you, I knew in general what they looked like, but it did seem like it was such a struggle to get set up that it took me years to decide to move into them. So I hope that what you're going to show us today will show the people how simple it can be.
It definitely will. Imagine this, folks. Imagine if all you did is changed one thing, okay? Every one of you can change one thing, and then you added one step. But what we're going to do is we're going to start with that one step. Now, let me come over here to the board. I want to just show you some basic things. First off, every one of you has an income. Now, that income comes from maybe one place, maybe multiple income streams. You could have a W-2 salary that you get. You might have a side hustle, a side business that you get some 1099 income, or maybe even a K-1 for a partnership. But it doesn't matter. You all have income that comes into your house. Now, what we've been taught to do with that income is we've been taught to put that money into our bank account. So I'm just going to write bank here. So we take the money that we earn and we put it into the bank. Now, some of you have actually gotten really smart. You've gone out and you've opened up a second bank account, or let's just call this a savings account. But here's how most people operate. They get their income, it goes into their bank, then the money from their bank first comes over here and pays off debts. Okay, so our debts and expenses come first. This is what we've been taught. Now, I'm not telling you this is right. I'm just telling you this is what we've been taught. We make money, and then we pay that money out on our debts, and I'm just going to kind of layer in our expenses. This is what we've been taught to do. Then anything that's left over after we pay all of our debts and expenses, we then save that money. Now, most people save it in a savings account. Some of you might even have a 401k, 403b, 457 plan. So some of you take money from your bank and you save it into there. This sums up about 99% of the population out there. This is what we've been taught to do. And we don't think there's anything wrong with this. But now, here's where I see a major problem. when I meet with people, and Christy, please tell me if this is what you see. I'm just going to draw a line down the middle. Okay. What we do is we meet with people. They've got income on one side and savings on this side. So let's just put this, your income comes in, we'll just write down W-2, 1099, whatever that is. And that income goes into whatever you save money in. So you've got your savings over here. Then on this side, okay, I'm just going to draw a line over. On this side, you've got your debts and expenses. So all these get taken care of. Your expenses, which would be your utility bills, your groceries, all that, all those things get paid. Okay, so money comes from our W-2, pays our expenses, but we've also got debts over here. And those debts are credit card debts, car loans, we've got student loans, sometimes we got medical loans, lines of credit. You all know all these debts that you have, but here's what happens. I see this all the time. I see people that have done a great job saving. They've got money in their savings account. Let's just say they've got 25,000 bucks they've saved, or this could be 10 grand. It could be 5 grand. Doesn't matter what the dollar amount is. And then I find that they've got a 401k at work and they've been doing a good job of putting money in there. So they've got maybe 30,000 saved in the 401k and they're deferring some of their income because they get a tax deduction and they get all these good benefits like a match and pre-tax, deduction or pre-tax contributions into the 401k. So they've got all this money saved over here. But then when I get to the other side and I look at their debts, in credit card debt, they owe $10,000 and they're giving away, let's just say $200 a month on that. And the credit cards are charging them 25%. Then they've got a car loan, maybe $20,000, and that's $500 a month that they're paying on that, and that's 7%. Then they've got their student loans, let's just call that $30,000, but that's okay because the student loans right now are 0% interest, but they're still paying $150 a month on that, which at $150 a month, they're never going to pay that off, or it's going to take a very long time. And they've got some type of a line of credit, and let's just call that $50,000, but that's okay because it's only 5% interest, so they're only giving $500 a month away. This is what stacks up. Christy, is this what you see often where people have done a good job of saving, they have a good income, but then they've got all these debts over here? Is this common?
Absolutely, every day.
So this drives me nuts, folks. I can't understand the logic that this is kind of how we've been taught money works. We make money, we work really hard for it, we save that money, but we've never connected the dots that the money we're saving over here that we feel comfortable with makes us feel great. It's our retirement, it's our emergency fund, it's all that feel-good money is sitting over here in accounts when we're giving all this money away. Look at these interest rates, 25, 7%. Even if we do 0% and 5%, no one ever does this. Let's just do this real quick. Just grab a calculator, folks, and just go into that and add up all your interest rates on all your debts. 25 plus 7 plus, well, we'll just do 0, and then plus 5, okay? That's 37. Now divide that by the 4, because there's 4 debts we just went over here. That means you're giving away 9.25% in interest. Just let that settle in real quick. And that's including a 0% loan. If we get rid of that 0% loan, that number is double digits. You're giving away 9.25%. Now, let's come back over here to your awesome savings accounts. Let's just assume that some of your savings is in one of those fancy, high-yielding savings accounts, making, 4%. Is 4 more or less than 9.25? A lot less. How much are you making in that 401k? Now, I know some of you are like, oh, I made 20% last year. But on an average, over the last 5 or 10 years, what have you averaged? Well, if you look at the averages, it's probably between 7, maybe 9%, but that's not the norm. That is still less than the interest that you're giving away every single year on all of your debts. And this involved risk. The savings and the high yield savings, that 4% or 5% you're getting today, that won't last. As the Fed keeps dropping rates, guess what? You keep getting a decrease in the amount you're getting on your money. So this is the connection I think a lot of people miss. You're giving away more in interest than you're making, but you can't understand why you feel like you're never getting ahead. Folks, it's just mathematics. So now, what if all we did is, let's go back to that first slide. And I want to make this simple, and then I'm going to actually show your audience exactly how this works. Now, what if all we did is if we took the money in our bank account and we sent that money over here and we paid down all these debts? Now, remember, on the last one, let's just add these debts up. Whoops, got to go one more here. These debts, 10,000, okay, 20,000, 30,000, and 50. So 50, 60, 70, 80, 90, $110,000 is the amount in debts. So now we got 110,000 in debts over here. So let's write that down, 110 grand, and that's all the debts. Now, what I also want to do is we got 110, but we're giving away $200 here to the credit cards. We're giving away $500 in this car loan. We're giving away 150 to the student loans, and then we're giving away $500 down here. So that's 1,350. I'm just doing quick math. Folks, you can do this with your stuff when you kind of get a chance. Just write all this stuff down. So that's $1,350. Come back over here, and then we're going to stay on this side. $1,350 a month. It's leaving your family forever. And all of this works out to be 9.25, I think it was, or 9.5% interest that we're giving away. So now just imagine this. We take the money from our savings and our bank account, and we reduce our 401k savings down to the match. So if you're getting a match of 3%, you back your 401k down to the 3, which frees up a bunch of savings every single month because you're not putting it into the 401k where it's almost locked in prison because you can't use that money for 5, 10, 15 years till you're 59 and a half. So why put the money here when we're bleeding all this money over there? So what we do is we take the money that we saved. I think I said it was 25 grand. Maybe leave 5 grand. So actually, let's keep 5 grand in there. So you take $20,000 from your savings in your bank account, and we come over here and we pay off your debts. Okay. When we pay your debts off by the 20, so you had 110, so we knock down $20,000. Now let's just assume that 20 grand that we pay off is going to pay and you're always going to go from either lowest to highest or avalanche. And Christy, I know you teach all that. But if we had 10 here and we had 20 there, we can definitely pay off the credit cards and free up $200 a month. So we come back over to this side, and let's just not do 20 for right now. Let's do 10 grand. Okay, 10 grand. So we're going to pay off the credit cards, 10 grand. So now we owe 100,000. The credit cards are gone, and we freed up $200 a month and 25% interest. I'm just making numbers up. It doesn't matter what they are. I'm just trying to get you to see what I'm trying to explain. This is what we just freed up. So once the credit cards are paid off, we no longer have to pay $200 a month to the credit card companies. But what we're going to do is we're going to pay $200 a month back to your bank account where the money came from. $200 a month is now coming back over here, filling this up. So that's $2,400. Okay, 200 is $2,400 a month that refills. So how long would it take of recapturing the 200 you were giving away to the credit cards to reimburse yourself the 10,000? You can do the math. Not very long. But you're also taking back 25% because you were giving 25% to the credit card companies. Now you're giving 25% to your bank account. By doing this over and over again, you're always going to continue saving money. Your savings is going to be higher because you're going to reduce that 401k down just to the match. Okay, so let's just write down match. And all the rest is going to go into your savings. So now every year we can take more out of the bank savings, and you can apply that over here to pay your debts off. It won't be long before all your debts are completely paid off, and it won't be long before $1,350 a month is put back into your bank account, and that would basically now regenerate all the money you took out. So now every payment you were paying to someone else's bank and all the interest you were giving them is now going back into your bank account. Bringing me back to what I said in the beginning is I can't understand why schools and other financial gurus don't explain, like, having savings is great. Putting money in a 401k is great, but not when you're giving a whole bunch more away to somebody else's bank. You need to smarten up, and you need to take the money that you're giving away and make that your money. You know, listen, in Robert Kiyosaki's book, Rich Dad, Poor Dad, he talks about turning liabilities into assets. What we just did here is I just showed you quickly, and I'm going to give you a better example. We showed you how to turn your liabilities, your credit cards, your car loans, your student loans, your lines of credit, your mortgages, turn those liabilities into assets. Now, I know it's going to be very hard for some of you in the beginning because you're so attached to your savings. You're so attached to putting that money there. But again, if you're like I used to be, because about a decade ago, I was buried in debt. And I felt like no matter what I did, no matter how much extra I made payments on those credit cards and those debts, I never felt like I was getting ahead. I couldn't get ahead. Mathematically, it was almost impossible, but I never connected the dots. If you're giving away a higher velocity of money than what you're actually keeping, how could you ever get ahead? You can't. This is why so many people in this country live in financial slavery. It's not because you're doing anything wrong. It's just because you've never been showed the right way to do this. Christy, with your velocity banking, and I apply that, folks. Listen, my house, my mortgage, Christy showed me, I don't remember when that was, last year, maybe the year before. You showed me how to apply velocity banking to pay off my mortgage. I'm happy to say next year, my mortgage will be completely paid off. And I didn't work any harder. I didn't work any longer, and I didn't take on any additional risk. I just listened to what Christy taught me. Then I apply that to this strategy, and now I'm able to do a lot more. Christy, I'm going to pause there. I got one more thing I want to show your audience. I want to show what would happen in this scenario if all we did is we stopped taking the money that we were giving away and putting it into a bank account where the bank wins, because the bank takes your money and lends it out at a higher rate. They make a spread. But what if we changed where your money went first? Instead of using a bank savings account, what if you created a banking system by changing where that money went first? And we put it into a specially designed and engineered whole life. I want to show you what that looks like, but I'm going to pause real quick.
You are speaking my language. I tell you, I work with people every day, Chris, every day. I had one just on Friday, and she was paying out over $1,300 per month in interest alone on her credit cards. And that is unbelievable because she did have $25,000 sitting in the bank in a savings account. And so I ran the numbers with her just like you did. And when she saw that she doesn't really have $25,000 in savings because her savings is depleted, and I mean, do the math. How long does it take $25,000 to be gone if you're paying out over $1,000 per month in interest? And it's just like you said, we are taught to use that savings account and not even pay attention to what those monthly payments are doing to us. That's why I think that you and I really have a connection with debt elimination, is because we're thinking along the same lines, that people are throwing away money that they could be, just with one or two steps, like you said, completely changing the outlook on their financial future. And I just appreciate you. I can't wait to hear how you're going to put all this into order here now.
Yeah, so now, as long as we can all agree, that what I just showed seems like a better way to handle money, and you don't have to. That's the thing. What we teach, like, you don't have to work harder. Like, nobody wants to work harder. They don't want to work longer to take time away from their family, and most of you, at least, should not want to take on additional risk. So that's all we're doing, is showing you how to do this without changing anything you're doing in your life, except for how you do everything. So now I'm going to bring it full circle, okay? And I'm going to do it by showing you how we've actually done this to help a chiropractor pay off $478,000 in debt in 6.5 years without saving more money, without taking on any more risk, and he certainly didn't want to work any longer. So I'm going to show you that. But remember, back in the beginning when we first started, I said this is not about a product. Now we're going to move into a product being added into this process that I just showed you, and instead of using a bank to hold your money, we're going to allow giant mutually owned life insurance companies to hold your money. And the reason for that is they are simply a better place to store your wealth. And they're a better place to store your wealth simply because of how a life insurance company operates. Now, remember, this is what I showed you before. It doesn't matter what we put in this box. Before, it was a bank account, and we moved the money around the circle. And remember, over here was debts, but we're going to expand on that. We're going to do debts. Maybe some of you are real estate investors. Maybe some of you want to invest in the S&P 500. Heck, I don't know. Whatever your investment choice is, we're just going to add that over to this side, okay? This is where your money gets to earn for you. You all have some place that you know, like, and understand to invest money. And then we're going to take the money from those investments, just like you do now, and we're going to put them back into the same place they came from. But instead of that being a savings account, we're going to substitute the bank account with a specially designed and engineered whole life. Now, there's a lot of reasons why we use a whole life. Number one, they pay a guaranteed interest rate of anywhere between 2 and 3.25%, depending on which insurance company we use. Not only that, all the insurance companies we use have paid dividends consecutively, never missing one, for well over 140 years. They've never missed a single one. So if we add the guaranteed interest plus the dividends, the companies that we work with are paying 5.75 to 6.3%. Now, unless you've got a bank account that guarantees you an interest rate for the rest of your life of that, and unless you've got a bank account that's paying you 5.75 to 6.3, we're already better than the bank account. Not only that, this money, if designed properly, which is what we do, okay, we can design these policies a very specific way, it will grow tax-free. So all that interest you're earning is tax-free money. Not only that, it's protected money. It's protected against judgments and liens in most states. And you can look that up. I'm not going to go deep on that. Outside of that, this is self-completing. It creates a legacy. Now, I know some of you are like, I don't care about a death benefit. I don't want more, money to go to my family when I'm dead, but you do. I've never met a family that doesn't care about the death benefit. I've delivered so many death benefits, and every single time that death benefit check is the only check that family's getting, because everybody else is coming with their hand out, waiting for a payment for a funeral, for flowers, a casket. This check, this death benefit check, is the only check some families will receive at that point in time. So it is vitally important. But the most important reason is, imagine taking your savings and putting it into the specially designed whole life first, and then immediately in the first 30 days identifying, like we just did a second ago, where that money can go to earn a higher rate of return than what the cost of capital is. So let's just say the whole life policy pays us 5.75 to 6.3. Remember, before, the debts were 9.25% in that other example. That interest rate is higher than what you're earning here. So it only makes sense to move the money from the whole life to over here. But here's where it gets even better. When we take the money from the whole life, we're going to take it as a loan. We're going to take a loan from the insurance company. We're not going to take a withdrawal. Okay, by taking a loan, that means that the insurance company lends us this money from their general account, meaning whatever money we have in the whole life, let's just assume you've saved up $25,000 in your whole life. You've got $25,000 earning at a rate of 5.75 to 6.3, depending on the insurance company. That money is growing tax-free. It's protected, and it provides a death benefit or a legacy. All that remains the same on all $25,000, even though we take $25,000 out. So let's say we have 25 in the whole life and we take $25,000 out. Most people would think there's no money left because they're doing it like a bank account. But again, you're taking a loan from the insurance company. So the insurance company is taking your 25, leaving it in there, letting it earn while they use it as collateral for a loan. So let me just do this, folks, because I don't want to confuse anyone. And I've got a really great way to show this. If you can just look at this example, and I'm going to bring this thing full circle for you. Okay. So now what we're going to do is we're going to look at these debts. This is the chiropractor's debts. Okay, this is a real case study, a real scenario. It's a bit old. We did this a while ago. But this chiropractor came to us after learning about what you just learned about and said, can you help me? And we said, I don't know. How much money are you saving? Well, first we identified he had debts of $478,000. Okay, he was giving away $5,777 a month. Add these monthly payments up. That's $5,777 a month. That's $69,324 a year. This was a massive problem for this chiropractor. So what we first said to him is we said, Mr. Chiropractor, in order to know if we can help you, we need to know how much money are you saving? So we quickly added it all up. He's putting some money in a 401k. He had money in a bank account that he saved every month. It was about $25,000. Now, folks, as you're listening, if 25 is like more than what you could save, just know that this is just an example. Your numbers will differ from what I'm showing you. So just kind of go along with it. This was just one example. So the first thing we said to the chiropractor, because we were logically thinking, is what if we took that $25,000 that you're saving and we just applied it to your debts? How long would it take to pay all these debts off? Well, the calculation showed 19 years, and the chiropractor said that's absolutely not possible. There's no way I can afford to pay $5,777 a month for 19 years. And we said, Mr. Chiropractor, are you willing to change one thing? That is where your savings, that $25,000 goes first, and adding one step. And if you do that, all your debts can be paid off in 6.5 years. What do you think the chiropractor said, Christy?
Yeah.
Show me the path. I'll walk you through this, folks, and we're going to start slow and we're going to go fast because this is very simple and it wraps up and sums up everything I just taught you before this. So first year, what the chiropractor is going to do is he's going to save $25,000 per year, and he could have broke it up into monthly savings, but $25,000 a year goes into a specially designed and engineered whole life insurance policy. What he then does is immediately after he makes the deposit into the policy, he takes a policy loan from the insurance company immediately in the first 30 days. Okay, repeat that, immediately in the first 30 days. So he's not waiting to do this. This is instantaneous. So in the first year, he takes out $14,863. So some of you are looking at that saying, that's awful. He put in 25 and he can only take out a smidgen over 14. That sucks. Yes, but just remember, there are costs for running this policy. There's a cost for the life insurance, there's commissions, policy service fees. All of that is shown in this number, the difference between the 25 and the 14. But in a second, you're going to understand why that doesn't matter at all. When we design and engineer the policies for you, I can tell you this, your numbers are going to look significantly better. And I know Christy's seen a lot of the designs we do. Her numbers are, she's looking at this saying, Chris, what kind of policy design is that? That looks nothing like the ones we've seen. Ours are way better. But I wanted to show you the worst case scenario so that you can understand that it's not about the product, it's about the process. So here's what the chiropractor does. Immediately in the first 30 days, takes this policy loan for the 14 and pays off Discover, pays off Lowe's, and pays down this Nordstrom. Now, by doing that, this chiropractor freed up roughly $448 a month. That was money that was going to Discover and Lowe's, and also the interest rates that they were giving away was 21% and 11%, just like I was mentioning earlier. So this is the first year. Year one, chiropractor only has to give away $53.29 to someone else's bank, and he's saving $448 a month. Now, here's what we told the chiropractor to do. And Christy, I know you tell your clients this too. We said, don't put this $448 in your black hole. Now, people are like, what do you mean black hole? The bank account where you pay all your bills, that's a black hole. Some of you will notice, or if you're anything like me, whatever money goes in my regular checking account where I pay my bills, at the end of the month, that number is always zero. I don't know why. It just always seems to be zero or close to zero. So what we did is we said, Mr. Chiropractor, we want you to go to a bank and we want you to open a second bank account. We're going to call this your segregated bank account. So he did that. And then what we did is we took the 161 from Discover, the 287 from Lowe's, and we had him transfer that every month, automated, into this newly created bank account. We said, do not get a debit card. A lot of people just can't handle debit cards. So we said, Mr. Chiropractor, please, no debit cards, no checks. You don't need them for this account. So what happens now is we go to year two. Year two, remember, the chiropractor changed one thing, and that was where his $25,000 a month in savings went, put it into the policy. He immediately takes a policy loan in the first 30 days of $16,571. Notice how that number is going up. Before, it was a little over 14. Now it's a little over 16. Why? Compounding interest. If you remember, I said it before, and I'm going to say it again. Every dollar the chiropractor is putting into the policy is still in the policy earning guaranteed interest plus dividends. It's compounding on an uninterrupted basis. Now, when he's using the money, that money is being used by getting a loan from the insurance company. So really, the cash value in the policy is just acting as collateral. So the insurance company is giving us these loans. Therefore, compounding interest is why you have more the next year and the next year. But we'll see more of that in a second. And then in that segregated bank account, we were saving $448 a month. That's now adds up to $53.74 after 12 months. So if we take the policy loan of 16, the payments that he was putting into that segregated account, which are now 53, he's got $21,945 that he can use to pay debts down. So now he uses that, pays off Nordstrom, Wells Fargo, pays the private loan off, and pays the BMW down. All these payments, 276, 271, 922, and the interest now are going to go into the segregated bank account. So now every single month, he's saving $1,917 a month in that segregated account. He's only giving away $38.60 in the second year, and he didn't have to work harder, longer, or take any risk to do this. He just followed a process. Now let's go to the third year. This is always my most exciting year. And almost every policy design that we do. Now, not every one is the same. Yours might differ from what I'm going to say in full transparency, but I want to say usually by the third year in the policy designs, yours will look similar to what the chiropractors did. He puts $25,000 into the policy and immediately in the first 30 days takes a loan for $25,541, which is $541 more than what he deposited. So now from this point forward, what I can tell you and what this chiropractor knew, he will always take more out than he puts in. There will never be a year that this chiropractor deposits money into his policy. He will take less out than what he put in. We already did that the first 2 years. We had a loss the first 2 years because we had to pay for a death benefit that will take care of our family when we're gone. But now, because of uninterrupted compounding interest, this policy is now at its efficiency point. So we take that loan immediately in the first 30 days for $25,541. He was saving $1,917 a month in that segregated account. Again, just the money he was giving away being repurposed. We call it recycle and recaptured into that segregated account. So he has $23,004 sitting in that account. If we add the loan plus the bank account, we have $48,545. So what we're going to do is we're going to take that money. We're going to pay off the BMW loan, pay off the West Marine boat loan, and pay down the condo. What that means is 3 years into this process, this chiropractor is only paying $2,100 a month to someone else's bank. He is saving $3,677 a month in that segregated account, which is all money he used to give away to someone else on the debt payments. So you see, all we're doing is we're turning liabilities into assets by teaching ourselves and following a process of how to be the bank instead of always using the bank. We are now becoming the bank. So let me show you this. Here's the marathon that we just went through. For 3 years, this chiropractor had to save $25,000 a year. So he put $75,000 into that specially designed and engineered whole life, of which every year we took loans from the policy. First year was 14, second year was 16, third year was a little over 25,000. So I just rounded them down. 55,000 came out in policy loans. How much money's left in the policy? By now, you're probably all looking at this and you're thinking, wait a second, I know this is a trick question, but 75 minus 55 is 20,000. That's what would be left in a bank account or a 401k if you did this. But remember, we didn't use our money, so we don't have 20k left. We have 75 because all 75,000 is still in the policy, working for us, earning for us, because now we're using the insurance company's money and our money's just collateralizing. So that's the marathon. It took 3 years to get to this point, but now let's keep going. The fourth year, same thing, puts 25,000 in, now takes 26,304 out, was saving 3,677 in that segregated account. So at the end of 12 months is 44,124. If we take the policy loan plus the segregated account balance, we've got 70,439. We're going to take that. And Christy, I always know this because this is the worst part of this. When we take 70,000 and we pay down our condo mortgage, it doesn't change our cash flow. Because when we make principal payments on a mortgage, nothing happens. So the fourth year, we saw no new money going into that segregated bank account because that's how an amortized loan works. That's why Christy's always talking to you about amortized loans and how bad they really are, but yet we're tricked into thinking that the interest rate they tell us we're getting is the best thing ever when it's really not. Anyway, I'll leave that one in your corner, but let's just go to the fifth year here. We put 25,000 in the policy. We now can take 27,000. See how fast that's building? It's because we've got 5 years of uninterrupted compounding interest working in your favor. It'd be like flying in an airplane, folks, and you've got a really strong tailwind behind the plane. What does that mean? That means your plane goes faster, but it doesn't burn any more fuel, and it doesn't have to work any harder. It just goes faster because of the tailwind. This, called uninterrupted compounding interest, is your tailwind. But now we got 27,000 we can take out as a loan. We got 44,000 again in that segregated account because we're still saving 3677, all the money we used to give away. So now in the fifth year, we're going to pay the condo off and we're going to pay our principal mortgage down to $91,000. So remember, chiropractor thought it was going to take 19 years to pay all this off using all of his savings. Now we're 5 years in. This chiropractor has only $91,099 left on his mortgage. He's paying $1,221 on that mortgage, and he's saving $4,556 a month. And that was all money he used to give away. He's never worked longer, never worked harder, and did not take on any risk. So now we're going to go to the final year. In the final year, this chiropractor goes to make his $25,000 premium deposit into the policy, and he realizes he can't. He can only put $10,000 into the policy. And the reason for that is because he hit what's called the MEC 7 pay rule. Now, folks, don't worry about that. This is nothing you need to know about. But the chiropractor now could only save $10,000. So he did. He made his premium deposit of 10 grand, and he immediately takes a loan in the first 30 days of $13,092. Let's pause here. He puts in 10,000, and now he can take 13,000 out. How much interest would $10,000 have to earn to give you back 13,000? Well, if any of you said 30%, you're right. So effectively, this chiropractor in the 6th year of that first policy is now, because of uninterrupted compounding interest, earning a 30% cash-on-cash return on his deposit he made. That excited him so much, he said, hey, wait a second, I want to keep putting more money into my banking system. How do I do that? And we said to him, well, you do it just like a bank. You open a second policy. You open a second branch office. So we did that. We set up a second policy for this chiropractor for $25,000. He immediately took a loan out for $14,863. So if we take the addition of the first policy loan, 13, plus the 14, he's got that plus $4,556 a month that was being saved in that segregated account, which is 54 grand. The total amount we have in cash to use is $82,633, of which we only owe $76,450. So we pay the house off. 6.5 years later, this chiropractor is 100% out of debt, now is saving $5,777 a month. And now what he does is, instead of letting the bank hold the $5,777, he now takes that and he applies that to the loan balance at the insurance company. So now every month, $5,777 is paying down the loan to the insurance company, but that still is different than paying any other loan, because now $5,777 that goes back into his policy, when it pays the loan down, that is $5,700 a month he has accessible to him. So folks, this is what being your own bank looks like. This is how it can work for you. And you can do the exact same thing that this chiropractor did by changing one thing and adding one step. So let me stop this and come back over here and stop share. So folks, that pretty much concludes it. But again, it's very simple. I gave you a case study. I hope that made sense. But again, whether you use a bank account or a specially designed whole life, it's the process that will make the difference.
God bless you. I swear you're amazing at your desire to help people use their money correctly. I am impressed every time I talk to you because I can see your heart and what you do. But a couple of questions that I have. You talked about paying back the insurance company after the debt has been paid off. Did I hear you correctly?
You did. Yep.
Okay. So you're talking about the 5,000 plus going back into the insurance company. But what you said was then you have that over $5,000 available to you to use again.
Correct. Yeah. So think about it this way. What we effectively did is we just created a banking system. That's literally it. We took what a bank does and we reverse engineered it and made it your banking system. So if you were a bank and you borrowed $5,700 from your bank, and then you put $5,700 back into your bank, how much money would be left in your account? $5,700. So all the while we were borrowing money from the insurance company, but we had our cash value in the policy still there earning interest and dividends. So all they did is they used our cash value to collateralize the loans that they gave us. And the loans, just so you all know that the insurance company gives us, what they do is they subtract it from our death benefit. So every time we take a loan from the policy, that's subtracted from the death benefit. So now when we take that $5,700 plus that we were saving in the bank account, we don't want the bank to hold our money anymore. So we just take that money, we put it back into the policy. The only way to put that money back in the policy is to repay the loan we took from the insurance company. But when we're repaying the loan, all we're doing is it's like a line of credit, right? If you had a line of credit and you maxed it out, but then you started paying it down, every payment you made minus the interest would be money you could take back out of the line of credit. This is no different. The insurance company is effectively giving you kind of a line of credit, which is basically giving you access to your death benefit up to the amount of cash value you have to collateralize it. So when you're making the payment back, of course it's $5,700 you have to use because you're not taking money or paying money anywhere. All you're doing is refilling the pot and making the money available to you again.
Okay, I'm going to jump up and run around the room because that's the first time I think that I've ever had anybody lay that out just like you did. So elementary. I can't even imagine why a person, myself, my family, anybody watching this video would not get on board with this because this is an amazing structure to get you out of debt while you're gaining wealth. That's absolutely wonderful. I swear I've so enjoyed this session with you, understanding that completely because I've had my own questions about where's the follow-up? You know, how do we pay this back now? That is as clear as I've ever heard it said. So that was excellent, Chris. That is excellent. I love this video. I am, of course, my mind is like thinking, okay, I can see throwing a simple interest line of credit into this and just really putting your process on steroids now because, you know, we're using the line of credit to free up cash flow, which is making you pay less interest in the future. For example, on some of those debts that were still remaining, you know, the first year, the second, the third, I can see turning those into lower interest lines of credit, gaining the payments that you're paying, putting it back into that savings even faster. So you're building the policy and paying it off even faster. I mean, I have all this stuff going through my head of scenarios right now, but
I love that.
I love it. I mean, I get so excited when I think about, you know, the simplicity of bringing the American people to financial peace. And I mean, you took this, I think that when people think of insurance companies, they automatically stand back because they're like, how's an insurance company going to help me? They only take money. And that's the truth. You know, it's like that when you're paying an insurance company, you're paying them for basically a risk, something that can happen. That just, you know, it's mind boggling. And it's just like, you know, when I teach people that you don't have to take loans, they stand back because they're like, well, that's all we know. And I mean, you have really put the light at the end of the tunnel here for people, and I am just so thankful that you're doing what you do, because I feel like that the more people that we can bring into a financial peace, they can think about things they need to be thinking about, which is their children, their family, their spouse, their the Lord, anything. And then something you didn't touch on too much, but something that was of great value to me when I started the whole life policies, my children's future is okay. And I think that me being a single parent, as long as I was, that bothered me because I knew that I was all they had and I had nothing to leave them. So not only are you're able to get yourself into a wonderful financial future here using these whole life policies that are designed for cash value, but now you have protected your family in the future that so that when you're gone, they're still going to be okay. And I just love it. I appreciate you, Chris.
Oh, my pleasure. And, two things I just want to preface, because I think sometimes it gets lost in all the different stuff that I just showed, is these are not normal whole lives that you would buy from, an insurance agent. You don't just call an insurance company and say, or an insurance agent say, hey, I need one of those whole life policies. You just saw this thing. They will not work this way. You will not have access to the money immediately in the first 30 days. And literally, you'll have no money available, usually in the first 30 or 3 years in a regular whole life. I preface this, these are specially designed and engineered from a contractual level. So it takes somebody that knows exactly how to design these like we do to build this policy design to work exactly how I just showed it. Because, I think a lot of people just hear this and they run out and they buy a whole life and they're like, oh, that's a scam. This doesn't work. It doesn't work because you didn't listen to the fact that these are specially designed to do what we just showed you. And you got to find somebody like us that knows exactly how to design them that way. And I love that you brought in the first lien HELOCs, because a lot of people are kind of strapped. They've got these beautiful homes which have gone up in value. They got all this equity locked in their house. Like, unlocking that equity either through a HELOC or a first lien HELOC, and then taking that money and running that through the policy, and then to whatever the end result is, paying off debt, buying cars or anything. That's great. And I'm going to finish with this one thing. I'd love, Christy, you just planted an idea for your audience, show you the policy design I did for my daughter. And because my daughter now is 4.5. I started this policy for her when she was 6 months old. But what this policy does, that I put $5,000 away into it a year, is it pays for her college. It pays for her wedding. It pays for a down payment on her house. It pays for her kids' college, and it pays her $90,000 tax-free every year until I basically took it to 90 years old. And at that point, she has millions of dollars left, a huge death benefit that when she dies passes on to her children. It creates the ultimate family banking system. And I'd love to show your audience what I did for my daughter.
I would like to have many videos with you showing exactly how it works in different scenarios, because just like I show people how to do velocity banking, in different scenarios, whether it be with a credit card, a line of credit, or a HELOC, whatever, you too have different scenarios that are just, going to work for everybody that can move into these infinite banking policies. One more question that I thought of that I had asked the other day. A lady had cancer and could not get or qualify for these policies. And I told her that you guys teach a way that you can get them on their children and their grandchildren. Can you go into that just a minute to talk about how that looks when you're dealing with someone that cannot qualify due to health reasons?
Yeah, it's really simple. So we have this a lot where somebody that wants to do what we just taught, finds out that medically they can't qualify for the insurance policy. So a lot of times they say, okay, what are my options now? Well, great. Your options don't have to be that you are the insured. Now, I know that's important for some people, because if you're the insured, that means the death benefit is on your life. So when you pass and go on to a better place, the death benefit would be paid out. But if you can't qualify, it doesn't mean you can't benefit from the banking functions that we just taught. So what we teach is we teach to find somebody in your family, somebody that's close to you. I mean, a lot of times it's a spouse, sometimes it's a child or children, or sometimes it's even grandchildren. Worst case scenario, let's say you're a business owner and you've got a partner or you've got key employees, it can be them. Now, let me pause and transition. All of you have gone into a traditional bank, and I bet you every time you've gone into a traditional bank, you have seen some banker with a little tag on him that says vice president. And you've probably never really thought about, why is there so many vice presidents at banks? I mean, do they really need that many vice presidents? Well, let me tell you a little known secret as to why banks have so many vice presidents. So banks, make no two ways about it, you can look it up on FDIC.gov, banks are the #1 purchasers of whole life insurance in the world. The top 5 banks have over $78 billion in whole life. They don't call it whole life, they call it BOLI, bank-owned life insurance. But I want you to key in on that. Bank-owned, okay? So what happens is the bank, because they're an entity, they can't take out a life insurance policy as a company. They need a body to insure. So they do that by promoting an employee into a vice president, which makes that employee an executive of the bank, meaning they have an insurable interest in that person's life. So, because if that employee died, that bank would have to come out of pocket a bunch of money to replace that employee. So here's how it works. The bank promotes an employee to a vice president. They say to that employee, hey, we're going to give you a small raise. We're going to give you a fully paid up life insurance policy for $50, sometimes up to $250,000 death benefit. We're going to also give you a deferred compensation plan that will be paid out when you spend the next after you spend the next 20 years of your life working for this bank. We're going to start paying you an income after that. That's what they offer the employee. And what does the insurance company do? The insurance company takes their tier 1 assets, their most valuable assets, our deposits that they need to hold. And they basically take that money and they buy a life insurance policy, a whole life policy on that employee. And then that employee basically, just gets a free death benefit when they die. But the bank gets to use that cash value, like we just showed, year over year over year. When that employee retires, they pay that deferred compensation plan from the cash value of that life insurance policy that they've been using for all those years. When that employee passes away, there's a death benefit paid out, of which 50 or 200, up to 250,000 goes to the vice president's family. Okay, now they're paid out. But you think that that's all the death benefit was? No, the death benefit on these BOLI policies is usually millions of dollars. So the bank gets recouped all of the money that they put into that policy for all those years, tax-free in most cases, because of that structure. So now let's go back to an individual. An individual is uninsurable. Remember, the bank was uninsurable because they're an entity. So the individual finds a child, takes out a policy on a child. The child's the insured. The parent is the owner. With ownership comes control. So the owner of that policy controls all the cash value of the policy, just like the bank controlled the cash value, and they can use it throughout their lives. Now, at a certain point in time, that owner, that parent, can turn ownership over to their child when their child's ready to manage it. But the death benefit does not pay out when the owner dies. The death benefit pays out when the child dies. That's the biggest difference. Sorry I went long on that, but I always thought it's a kind of a fun thing to talk about.
No, I apologize for holding you over, because I am so interested in what you teach that when you lay out those scenarios, it helps me to understand. That's why, when we start these videos, I always say, do it in elementary terms, because I'm an elementary mind. I'm not thinking millionaire status. I'm thinking somebody that's bringing home about $1,000 a week. This is something you can do. You can do this. This is not some far-fetched idea that, the basic American cannot do. And I think that that's why I love it so much. Is I heard about this 15 years ago. It's been a long time. But I myself didn't even get started in these until 6 or 7 years ago. And you guys, since I found the Chris Doggle group, it's like you have expounded so much on how they work that I have done 4 in the last year. So I am so excited. This isn't something that I am telling people to do that I'm not doing myself. And I want to be really careful with that, because I don't want to act like that, I'm trying to sell something. This is not a sell. This is something that can change your financial life, not just for you, but for your children and your grandchildren. And what a beautiful legacy to leave. I just appreciate you so much, Chris, for coming on and for just inspiring me to, do better with my money, put my money to work, and in a way that I never even thought was possible. And I know there's people watching this video right now that are saying, how do I get started in this?
There's a video where they can watch the video, which will walk them through A to Z on how this works, and then they can book a call with the team. And just, I love that you said, we're not here to sell anything. Our team will look and find out what that client's, problem is. What is it that they're trying to do, and what problem can they solve? We will show them how using the infinite banking concept will solve their problem, and will mathematically prove it. And then the client, every single time, will ask us to help them get started. We don't have to ask for the sale, because if you solve somebody's problem, that client will ask you to help them.
That's awesome. Well, thank you again so much for coming on and sharing this life-changing information. I swear, it's beautiful. I love it. I appreciate you. And guys, if you're watching this video and you have been stirred like I am, check out the link below. You're going to love working with this team because they, just like myself, they want to see you do better. They want to see you do better for your family. And I appreciate that. So thank you again, Chris. Guys, if you have any questions, leave them below. I look at them every day, and I'll be glad to answer any questions that you have because we just want to help you. So thank you for watching today, and I look forward to seeing you in the next video.